Hello everyone, my name is Hitesh and I welcome you all to the TradeBins YouTube channel. If you're new to this channel, please comment, like and subscribe on our videos, and please don't forget to press the bell notification icon so as and when we publish the videos, you get a notification straight onto your device. Now through this videos, I'll be going to be dealing with one of the very important concepts, that is the concept of mutual funds. And while explaining the mutual fund, I'll be covering up various important technical terms which we sometimes hear in the mutual funds, but we don't understand exactly what do they mean. So I'll be trying to break down those terms in the simplest way possible. So without wasting any time, let's jump right into it. Now before understanding the mutual fund jargons, let us try and understand what exactly mutual funds are. Because if we have a clear understanding of what exactly a mutual fund means, it will be easier and simpler to explain the various jargons which we always hear, which we sometimes overlook while taking or buying a mutual fund. So a mutual fund in simple terms is basically a pool of funds which is being collected from various investors, which is then managed and invested by an asset management company. Now this pool of people, that is the investors who are not exactly willing to be a part of the stock market directly, but are still willing to invest their money. So what they do is they give out their money to a big fund which then invests the money for them and gives returns to them. These funds are managed by professionals, basically who are qualified, who understands the capital market or the various markets where the money will be invested in a very complete and concise way. Now these funds are being regulated by AMFI. AMFI is the regulatory body which regulates the mutual funds in India. AMFI stands for Association of Mutual Funds in India. The advantages which the mutual fund have is the scales. By scale I mean the size of the fund. Because the money comes from various investors, the fund is always bigger in size. There is an advantage of diversification because the fund managers diversify the portfolio in such a way that they take the minimal of risk but yet try to generate decent rewards for the investors. And the liquidity and professional management is one of the important factors because not everyone has the same objective in mind when they're trying to invest in mutual fund. Some people want to invest for longer time, some people want to invest for shorter time. So liquidity has to be available with the fund all the time, so that as and when someone wants to withdraw the money before the maturity, before the specified time, the mutual funds always have the money to give out to them. And the funds are always managed by professionals because if you're not professional while trading and if you get emotional while trading, you always tend to make more wrong decisions in trading. So these are always managed by professionals. Now the jargons which I'll be trying to cover in this video about mutual fund would be the AMC, which is the asset management company. Then the second jargon which I'll be covering is the NAV, that is the net asset value. We'll be explaining the concept of AUM, that is the asset under management, the entry and exit load of the mutual funds, and the last but not the least, the expense ratio. These 5 terminologies, if we have a clear and decent understanding, we always can understand what the mutual fund is trying to communicate to us. So let us begin our discussion with the first jargon. The first jargon which I'll be talking about is the AMC, that is the asset management company. An AMC is a financial institution which is regulated by Association of Mutual Fund in India that manages your fund. Basically, as and when you have supposedly some money to invest and you're not aware exactly when to invest, so you go to a fund house, that is the financial institution in this case. You give money to them and they manage your money in a professional and a concise way. They invest in various avenues like the stock market, the bonds market, the debt market, the real estate market, that various kind of markets which are being invested by the mutual fund companies. And there are about 44 to 45 big size asset management companies in India. So we always have a lot of options where we can go and where we can invest our money. Now the assets are allocated depending on the objective of the fund. Now this is very important for us to understand. If you are someone who is willing to invest in good stocks, then say for example you go for a blue chip company stocks. Now a blue chip fund is a fund which manages in the top companies which are trading in the Indian stock market. I'm talking about the companies which fall in the Nifty 50. I'm talking about the large mid-cap companies also. Those are the funds is where the money is being invested in this kind of funds. So depending on the objective or depending on the kind of fund which we choose, the money goes in that. Some people like to invest in gold fund. Say when you invest in gold fund, the asset management company invest your money in the gold futures or the various other gold traded funds. And if you're someone willing to take more risk and want to invest in the mid-cap company or the small cap company, so you have funds which satisfy that kind of profile also. You have funds which give you funds for mid-cap companies. You have funds which give funds for small cap companies. So depending on the one's objective, you can choose the fund you want to invest in. Now, how is the portfolio constructed? When I say a blue chip company, there are more than 50 to 100 or maybe more than 200 blue chip companies in India. So it is not possible to invest your money in each and every company. So after proper research and analysis, the fund manager picks up the best company which is suitable for the fund to give the maximum returns to its holders or to the investors in the mutual fund. So after proper analysis only, the fund manager chooses the company where they want to invest. This is very important because the funds are being funded by trustees. There are some funds where people have invested money worth of crores and millions of rupees. So they exactly want to know what's happening to the fund, where the money is going. So the fund manager or the fund house is liable to give each and every information which happens to the fund, as in when they put the money in the fund, which stocks they have bought, which stocks they have sold, when did they buy, when did they sell, the price at which they bought, the price at which they sold. Each and every information which has to be intimated by the mutual fund house to the investors of the fund. Now, these are some of the big asset management companies in India. I'm talking about the HDFC Mutual Fund Company, the SBI, the IIFL, IDFC, UTI Mutual Fund, the Kotak Fund, DSP Fund, Invesco Mutual Fund, ICICI Prudential Mutual Fund. These are some of the big asset management companies in India. They invest your money in a very judicious and a very professional manner. Now, the next jargon which I'll be trying to explain is the concept of NAV, that is the net asset value. Now, in simple terms, it is the unique price of the fund. Now, whenever you try to search a mutual fund, you supposedly, if you go to the website of moneycontrol.com and you supposedly search Axis Blue Chip Fund, you see a NAV which is about 29.35 or 29.36. That is the unit price of each and every unit of mutual fund. The NAV is very similar to the stock price of a company. Now, when you buy the stocks of a company, you own the shares of the company, and the prevailing market price of the share of one share of the company is the price for that share. Similarly, in mutual fund, NAV is the price of one unit of mutual fund. How is NAV useful? Now that I've told you that this is what NAV means, I have to explain you what exactly does NAV use. Supposedly you want to invest in a certain mutual fund, but you see the NAV to be very high. So you would look out for alternative option which has a lower NAV. So as and when you find a fund which suits your risk profile, but it is available at a lower NAV, it is available at a lower price, you tend to invest in that fund. So having a proper analysis and understanding of NAV, you get the right fund to invest in the market, which maximizes your return in future. And the value of NAV, just like the share price of the company, keeps changing from time to time. Now, the NAV keeps changing not on like live market basis. The NAVs keep changing after the market is settled. That is, the Indian equity market is settled. It keeps on changing on day-to-day basis at the end of the trading in India. Now, the next concept which I'll be talking about is the concept of AUM, that is the asset under management. Now, the asset under management is the total value of the assets which are being managed by the fund. It is like if I have 10 investors who are willing to put money with me and I am the fund house, and if they all have combined put about 1.5 lakh rupees to be invested, then the asset under management for that fund will be 1.5 lakh rupees. Now, AUM is the summation of total investments made plus the cash held in the reserves. Now, if I already told you that mutual funds have some liquidity for the investors if they want to pull out the money before the maturity date. So the asset under management for a firm would be the amount of total money which has been invested in the market plus the cash which is held by them in the reserves. The summation of those two factors give you the total value of asset under management for that particular fund. Now, AUM is a function of performance of the fund. Say if the fund is performing well, if the value of NAV goes up for a particular fund, then the firm has higher amount of asset under management, and if the NAV of the firm is low, then the firm has lower amount of asset under management for that particular fund. As I already told you, the good performance by the fund always implies higher asset under management, and if the fund is not performing that well, that simply would give an indication that the fund has lower asset under management. And the asset under management, that is the total amount of fund which is available in that particular mutual fund, are being managed by professional fund managers. Now, these are the example of some of the total asset under management of some blue chip funds. The first one being the Axis Blue Chip Fund, that is about total asset under management of about 14,500 crores. The SBI Blue Chip Fund has an AUM of about 22,000 crores. The Franklin India Blue Chip Fund has an AUM of about more than 5,000 crores. Similarly, the ICICI Prudential Blue Chip Fund has a asset under management of about 24,000 crores, and the Myra Asset Group Emerging Blue Chip Fund has a AUM of about 10,500 crores. So different mutual funds have a different amount of asset under management, and generally if the fund has a large amount of asset under management, which means that the investors have a higher faith in that fund. Now the next technical jargon which I'll be explaining is the concept of entry and the exit load. Now before understanding the concept of entry and exit load, let us understand what exactly a load implies. Now load is a fee which is charged when we buy or sell a unit of the fund. Now as and when I buy say one unit of the fund, there's a certain amount of fee which I have to pay to the fund manager or the fund house. That is called the entry load. And as and when I want to exit the fund, there's a certain fee which is charged by the fund houses. That is called the exit load for the fund. Now to explain the concept of entry load, it is the initial fee which is being paid at the time of entering the fund. That is, as and when I want to invest in a particular mutual fund, I want to invest a certain amount of money. There's a certain amount of fee which is being charged by the fund house. That amount of money is called the entry load for entering into the fund. It is generally a certain percentage of the net asset value of the fund. Say if the entry load is 1% for a particular fund, and if I want to invest say rupees 10,000 in that particular fund, then rupees 100, which is 1% of that value, will be charged as the entry load for the fund, and the balance of 9900 will be invested in the mutual fund. And in India, the entry load is generally about 2 to 2.5% of the total value of the fund. And what exactly is an exit load? Now, it is generally the amount of fee which is being charged at the time of exiting from the fund. As in when you exit your position from the fund, or as in when you withdraw some money from the one fund, you pay a certain amount of exit load. Now, exit load is generally not charged as in if you hold the fund up to the specified time period. But if you withdraw your fund before the specified time period, you have to pay a certain amount of exit load. And it is generally between 0.5% to 1% of the total amount withdrawn. And say if you want to withdraw an amount of rupees 10,000, then your exit load charge for the fund is 0.5%. Then the total fee charged will be rupees 50, and the balance of 9950 will be returned to the investor of the fund. Most important concept and the last concept of this video will be the concept of expense ratio. This ratio is very important for a fund because it actually has a huge impact on the amount of return which can be generated by the fund. How does that happen? Let me explain you that. Now, in simple terms, an expense ratio is the total amount of fee which is charged by the asset management company for managing your fund. Now, we must all be aware that if I want services from someone, I have to pay a certain amount of fee or commission to it. So an expense ratio is generally a fee or a commission which is paid to the fund manager or the fund house for managing my fund. The expense ratio covers the various expenses like the fund manager fee along with the other administration and operational fee. Now, if I'm buying or selling certain asset, there's a certain fee which I have to pay for that also. Even that becomes a part of the expense ratio which has been incurred by the fund. Now, it is always advised to select the funds which have low expense ratio. Now, supposedly if you select a fund which has an expense ratio of about 1%, then the amount of money which you have invested in the fund, the 1% will be charged as an expense ratio on an annual basis. And supposedly if you have a fund which has a lower expense ratio of say 0.5%, 0.6%, then you have to pay the fee of only that much amount for managing your fund. So it is always advised to select a fund which has a low expense ratio. But we shouldn't compromise the quality of the fund just because it has got a low expense ratio. Quality with low expense ratio goes a long way in generating better returns from our fund. The direct mutual funds always have a lower expense ratio compared to the growth plan which is being offered by the fund companies. And generally the expense ratio in India varies between 1% to 2.5% of the total amount of money which you have invested in the fund. So this is the broader range under which the expense ratio falls. I hope we got a basic understanding of the technical jargons which are used or the technical terms which are being used in the mutual fund. If you have any question, please put your questions in the comment section. I'd like to answer them as soon as possible. And I thank you for your patient hearing. I'll see you in the future educational videos. And all the best and happy learning and happy investing. Thank you so much.